the dramatic tug-of-war between U.S. trade policy, geopolitical tensions, and the smart money quietly positioning themselves while retail investors cheer on headline optimism. Our focus today is on the so-called Trump 100% tariff saga, and how Wall Street reacted in a way that tells a much larger story about investor psychology, risk management, and the fragile nature of short-term rallies in an era dominated by high-frequency trading, artificial intelligence, and global interdependence. To understand the context, let's start from the top. In recent months, the U.S.-China trade relationship has resembled a high-stakes chess game, with tariffs and counter-tariffs moving like knights and rooks across the global economic board. President Trump's initial threat to impose a 100% tariff on all Chinese imports sent shockwaves through financial markets, creating panic selling, volatility spikes, and widespread uncertainty. Headlines screamed about potential disruptions to supply chains, the cost of consumer goods, and even the possibility of a slowdown in U.S. economic growth. From the perspective of the average investor, it seemed like a black-and-white scenario. The White House threatens extreme tariffs, stocks tumble, panic ensues, and the sky is falling. But financial markets are rarely so simple. Beneath the surface, institutional investors, hedge funds, and high-frequency traders were quietly analyzing the probability of these tariffs actually being enacted, the likelihood of diplomatic negotiations, and the timing of any public statements that might move sentiment. And this is where things get interesting. On the day in question, the major U.S. indices, the S&P 500, NASDAQ, and Dow Jones Industrial Average, experienced a sudden rebound. Headlines highlighted the gains, emphasizing relief that the markets were recovering and that the worst-case scenario appeared to have been averted. The VIX, often called the Fear Index, fell sharply, signaling temporary calm. Regional banks, which had been battered by volatility, also rebounded strongly. Yet, savvy market observers noticed something crucial. The rebound was largely driven by headline optimism rather than fundamental shifts in trade policy or economic conditions. Behind the scenes, billions of dollars of stock were quietly sold in dark pools, private trading venues that allow institutional investors to buy and sell large blocks of shares without immediately impacting market prices. According to data from AI-based platforms like StockWe.com, roughly $4.1 billion worth of SPY and QQQ shares changed hands in these off-exchange trades within minutes of Trump's comments that the 100% tariff threat was unsustainable. In other words, while headline news painted a picture of market confidence, the smart money was quietly taking profits, positioning themselves defensively, and testing the sustainability of the rally. This opening sets the stage for a key theme that will run throughout our analysis today. In modern financial markets, headline optimism and fundamental reality are often two very different things. Retail investors and casual observers react to statements, news alerts, and trending narratives, while professional investors use deeper analytical tools to assess risk, evaluate liquidity, and anticipate volatility. What looks like a smooth recovery on the surface can mask underlying tension, unpriced risks, and potential shocks waiting to ripple through the market. We also need to consider the broader macroeconomic and geopolitical context. The U.S. administration's trade policy, particularly regarding China, is not merely a domestic political story. It affects global supply chains, multinational corporations, consumer prices, and investor sentiment worldwide. China's rare earth exports, semiconductor supply, and advanced manufacturing are all entangled in this trade narrative. Any sudden moves or escalations could have repercussions across industries such as technology, automotive, energy, and defense. At the same time, we are in the midst of a technological transformation with AI driving both market speculation and real economic shifts. NVIDIA's Blackwell AI chip, now US-made, highlights America's push toward AI-era reindustrialization. investors are closely watching which tech companies can turn massive AI capital expenditures into actual returns. This adds another layer of complexity because, during periods of geopolitical uncertainty, high-growth sectors often see outsized swings in valuation, regardless of the underlying fundamentals. On the Friday in question, U.S. financial markets experienced what looked at first glance like a broad-based recovery. The S&P 500, NASDAQ, and Dow Jones Industrial Average all posted gains, a welcome reprieve for investors who had endured a week of volatility, uncertainty, and geopolitical tension. Headlines across Bloomberg, CNBC, and the Financial Times were optimistic. Markets rally as trade fears ease, and Wall Street ends the week strong. For many retail investors, it seemed like a signal that the worst of the risk had passed. However, the true story behind these numbers is far more nuanced. The market rebound was driven largely by two critical factors. First, there was relief regarding financial liquidity. The Federal Reserve's Standing Repo Facility, SRF, which acts as a safety net for banks to access short-term liquidity in times of stress, went completely unused that day. For months, concerns over systemic liquidity had weighed on markets. Banks, hedge funds, and institutional investors worried that insufficient access to cash could amplify volatility. When the SRF was not tapped, it signaled to markets that immediate liquidity risks were low, giving a psychological boost to traders and investors. Second, optimism came from developments in U.S.-China relations. Trade tensions between the two countries have been a persistent source of uncertainty since the start of the year. Markets reacted positively to signs that discussions were progressing, and that extreme measures, such as a threatened 100% tariff on Chinese goods, might not materialize. Even minor signals of diplomacy, such as statements from Treasury officials confirming ongoing discussions, were enough to spark short-term buying. Despite this, it's essential to recognize that surface-level rallies like this are often deceptive. While headline indexes moved higher and the VIX, the so-called fear gauge, dropped, indicating lower implied volatility, these metrics can obscure underlying realities. Retail investors and media outlets often focus on daily gains or losses, interpreting them as confirmation of trend reversals. Meanwhile, institutional investors, hedge funds, and algorithmic trading systems take a more cautious approach. They consider a broader range of factors, including macroeconomic indicators, geopolitical risk, corporate earnings guidance, and derivative flows. Indeed, while indexes rebounded, data from dark pools and AI-driven trade analysis indicate that large sums of capital were quietly moved out of equities. Smart money was not convinced that the risks underlying the market had vanished. They were merely taking advantage of temporary relief to reduce exposure or rebalance portfolios. This divergence between visible optimism and professional caution is a recurring theme in modern markets. It underscores the critical point that not all rallies are created equal. Some are temporary, headline-driven reactions rather than genuine recoveries rooted in fundamentals. Moreover, the sectors driving Friday's rebound provide further insight. Regional banks, which had been under intense scrutiny due to deposit outflows and liquidity concerns, led the gains. This sector-specific strength was interpreted as a sign of financial stability, but it was largely technical, based on short-term relief in funding costs, rather than a comprehensive return to confidence. In other words, while the banks rose, the broader economic picture remained clouded with uncertainty. In addition, Friday's rebound was affected by the psychological state of market participants. After weeks of negative news cycles, including concerns about trade, inflation, and interest rates, any hint of positive developments tends to trigger knee-jerk buying. This is a classic relief rally, where investors react more to sentiment than to changes in fundamental economic conditions. Importantly, such rallies can be fleeting. Without sustained improvements in policy, corporate earnings, or global stability. These rebounds are vulnerable to rapid reversals. Focuses on the market's reaction to a very specific development in U.S.-China relations: President Trump's apparent pivot on trade rhetoric. In recent weeks, markets have been jittery due to repeated threats of extremely high tariffs, including the highly controversial 100% tariff on Chinese goods. Such extreme measures, unprecedented in modern trade history, create substantial uncertainty because they directly impact global supply chains, corporate earnings, and investor confidence. When Trump publicly labeled the 100% tariff as unsustainable, it provided a strong psychological relief to markets, essentially signaling that diplomacy might prevail over confrontation. It's important to contextualize this pivot. Tariffs are more than simple economic instruments. They are highly visible political tools. Investors closely monitor them because sudden announcements can disrupt everything from tech supply chains to commodity prices. For instance, rare earth elements, critical for AI chips, electric vehicles, and defense systems, are heavily sourced from China. A full-scale 100% tariff would not only risk reciprocal actions from Beijing, but could create immediate shortages for U.S. manufacturers, pushing costs dramatically higher and squeezing profit margins. By indicating that the extreme tariff plan is unsustainable, Trump effectively reduced the immediate perceived risk of supply chain shocks, which was enough to buoy the market. Adding to the market's sense of relief were concrete diplomatic signals. Trump confirmed that he would meet South Korea's president within 2 weeks. While this might seem tangential to U.S.-China trade negotiations, it has broader geopolitical implications. South Korea plays a strategic role in the Asia-Pacific economic and security landscape. Engaging with Seoul demonstrates a willingness to negotiate within multilateral frameworks and sends signals to Beijing that Washington is open to dialogue. The market interprets these meetings as stabilizing because they indicate that the administration is not pursuing unilateral, aggressive trade escalation. Simultaneously, Treasury Secretary Bessent confirmed a series of calls and meetings with Asian officials. These were aimed explicitly at discussing rare earth export tensions, technology supply chains, and trade stabilization. In other words, the administration was not merely signaling verbally. It was actively engaging in policy coordination with foreign counterparts. For market participants, these calls and meetings served as tangible evidence that behind the headlines, professional diplomacy was in motion. It is one thing for a president to make statements on Twitter or in press briefings. It is another for top Treasury officials to be in direct dialogue with regional economic leaders. This distinction matters significantly for institutional investors, who prefer verifiable actions over rhetoric. The market's immediate response was mixed, but generally positive. Volatility, as measured by the VIX, decreased, and regional banks, which had been under stress due to liquidity concerns, experienced a notable rebound. Yet, as with Slide 1, this optimism was cautious. Analysts noted that while the news reduced immediate fear, it did not eliminate underlying structural risks. For example, the administration still faced the challenge of negotiating effective tariff reductions, ensuring compliance with existing trade agreements, and managing retaliatory measures from China. Markets understood that the road to a stable trade environment is rarely linear, and that temporary optimism can be followed by renewed turbulence if talks falter. It's also critical to examine the behavioral psychology driving this market response. Investors are highly sensitive to statements by political leaders, particularly in the context of trade. The mere phrasing of Trump calling a tariff unsustainable carried outsized influence because it reduced the perception of extreme risk. This is a classic example of a sentiment-driven market reaction, where perception, confidence, and risk expectations drive short-term price movements more than fundamental economic changes. Financial institutions monitor these cues closely and often adjust positions preemptively, which can amplify market swings. Delves into the dichotomy between headline-driven market optimism and the behavior of institutional investors, commonly referred to as smart money. While retail investors and day traders often respond to news sentiment, the underlying market currents are largely influenced by large-scale players such as hedge funds, mutual funds, pension funds, and proprietary trading desks. This slide highlights a critical point. Despite Trump's conciliatory rhetoric regarding tariffs and the subsequent modest rally in U.S. equities, the most sophisticated market participants chose to exit positions almost immediately, signaling a lack of faith in the sustainability of the rebound. The phrase faithless rebound captures the essence of this market phenomenon. On the surface, Friday's trading session appeared bullish. The S&P 500, Dow Jones Industrial Average, and NASDAQ Composite all posted gains. Yet these were relatively modest, averaging only around plus 0.5%. For context, in a normal recovery after a meaningful negative shock, one might expect a more pronounced catch-up rally. The modest nature of this rebound suggests that while the news reduced immediate fear, it did not convince market professionals that the underlying structural risks had abated. This is a key distinction. Headline rallies can be superficial, masking deeper investor caution. A striking piece of evidence for the cautious sentiment comes from data on dark pool trading. Dark pools are private exchanges or forums for trading large blocks of securities away from public exchanges. They are primarily used by institutional investors to execute large trades without causing significant price movements. According to stockway.Com AI analytics, approximately $4.1 billion worth of SPYS and P500 ETF and QQQ NASDAQ 100 ETF shares were sold in dark pools shortly after Trump's public comments on tariffs. This indicates that while the broader market appeared to respond positively, the smart money was quietly exiting or reducing exposure to equities. The timing of these sales is particularly notable. The liquidations occurred just minutes after Trump described his 100% tariff threat as unsustainable and hinted at potential diplomatic discussions. From a behavioral finance perspective, this is illustrative of a common dynamic. Retail investors and algorithmic trading bots often react immediately to headlines, driving short-term price spikes, while institutional traders anticipate that such spikes may be temporary and take advantage of the price movement to offload risk. Essentially, fast money capitalizes on optimism-driven buying, turning temporary sentiment into liquidity for strategic repositioning. This pattern also underscores the importance of understanding market microstructure. Institutional traders are typically more concerned with risk-adjusted returns than with short-term price movements. They analyze macroeconomic data, policy announcements, and geopolitical developments in a nuanced way. The sale of $4.1 billion in dark pools reflects a careful risk management strategy. While public commentary may suggest easing trade tensions, the broader risk environment, including uncertainty over actual tariff implementations, retaliation measures by China, and potential market reactions to upcoming earnings, remains highly unpredictable. Selling into strength allows institutions to reduce exposure without triggering major price slippage, a tactic unavailable to retail investors operating in the visible order book. Another critical layer is the behavioral psychology of market participants. The faithless rebound concept is closely related to the theory of asymmetric information. Institutional investors often possess deeper insights, proprietary research, or real-time intelligence that is not immediately available to the public. They may interpret policy signals differently, viewing optimistic statements as incomplete or conditional. In this case, Trump's comments were likely seen as provisional, contingent on upcoming negotiations, geopolitical events, and internal U.S. policy debates. By contrast, less sophisticated traders often interpret such statements at face value, generating the visible, short-term market lift observed in the indexes. This dynamic has implications for both trading strategy and risk management. Market participants who observe a headline-driven rally must differentiate between noise and sustained trend shifts. The lesson from Slide 3 is that headline optimism can create opportunities for tactical selling by sophisticated players. For risk managers, the signal is clear. Short-term rallies should not automatically be interpreted as a shift in underlying market fundamentals. Instead, one should monitor dark pool activity, liquidity flows, and institutional positioning to gauge the true sentiment behind price movements. Focuses on the structural and technical aspects of financial markets that set the stage for heightened volatility in the upcoming week. Unlike the previous slides that dealt primarily with geopolitical factors and headline-driven sentiment, this slide emphasizes the mechanics of market microstructure, options trading, and the timing of liquidity events. These factors often go unnoticed by casual observers, but are critical for understanding why even seemingly minor news events can trigger disproportionate market reactions. The first point of note is the major options expiration on Friday. In financial markets, options expiration refers to the date when options contracts, derivatives giving the right, but not the obligation, to buy or sell a stock or ETF at a set price, expire. Large volumes of open options contracts need to be either exercised or allowed to expire worthless, and this process can significantly influence the underlying stock price and volatility. Specifically, the expiration of large numbers of S&P 500, SPY, NASDAQ, QQQ, or individual stock options can result in sudden, sometimes dramatic price moves due to hedging activities from institutional traders, market makers, and algorithmic trading systems. The phrase, "removed the seatbelt from volatility," aptly captures this phenomenon. During periods leading up to options expiration, many market participants maintain hedges to manage directional and gamma risk. Gamma risk refers to the sensitivity of an options portfolio to movements in the underlying asset price. Essentially, traders maintain positions that stabilize price movements, the metaphorical seatbelt. Once the options expire, those hedges are unwound, removing stabilizing forces and creating the potential for abrupt swings. In this context, even a modest news item, whether related to tariffs, corporate earnings, or geopolitical developments, can become amplified, producing the kind of flash market moves often referred to in high-frequency trading circles. Expectations for the VIX, the CBOE, volatility index, are particularly important for understanding market psychology next week. Often referred to as the fear gauge, the VIX measures implied volatility of S&P 500 options. When the VIX rises, it reflects heightened uncertainty or fear among market participants. Currently, with the expiration removing stabilizing hedges, analysts anticipate that the VIX could spike as risk management flows are unwound. In practice, this means that the market could experience rapid intraday swings of 1 to 2% in broad indexes, which is significant given the recent volatility fatigue from trade and AI-related risks. Traders and risk managers should be aware that a rising VIX often correlates with a widening bid-ask spread, reduced liquidity, and increased sensitivity to macroeconomic or geopolitical headlines. Also addresses option flow resets. This refers to the resetting of delta, gamma, and vega exposures among traders and market makers after the expiration of options contracts. Delta represents sensitivity to the price of the underlying asset. Gamma measures the rate of change of delta, and vega captures sensitivity to volatility. When a large number of contracts expire, market makers must adjust their positions to maintain a neutral exposure, often buying or selling the underlying stock in the process. This can create a temporary but significant imbalance in supply and demand, leading to rapid price movements. For traders, understanding these dynamics is crucial. It's not only the news or fundamentals driving the market, but also the mechanical adjustments of derivative positions. Another factor contributing to the volatility trap is investor psychology. Despite Friday's apparent relief in equity markets following Trump's comments on tariffs and trade diplomacy, sentiment remains fragile. Investors are still digesting structural risks, including ongoing U.S.-China tensions, AI investment cost concerns, earnings season expectations, and Federal Reserve policy signals. When optimism is shallow and markets are technically unprotected due to options expiration, even minor news can trigger outsized reactions. This creates a heightened probability of flash corrections or abrupt rallies, reinforcing the idea that headline sentiment may not reflect underlying stability. Explores the intersection of three major forces currently shaping U.S. and global markets: the AI revolution, evolving trade policies including tariffs, and the seasonal influx of corporate earnings reports. Each of these factors has the potential to independently drive volatility, but when they converge in a compressed time frame, as they are doing in Q4 2025, the market becomes exceptionally sensitive to both news and technical catalysts. The first major theme is artificial intelligence and industrial strategy, exemplified by NVIDIA's launch of its Blackwell AI chip, now manufactured in the U.S. This represents more than just a technological milestone. It signals a significant shift in American industrial policy toward domestic production of high-value, AI-era semiconductors. Jensen Huang, NVIDIA's CEO, described the moment as historic, underscoring its strategic importance. By producing the Blackwell chip domestically, the U.S. mitigates geopolitical risk associated with foreign manufacturing, particularly in light of ongoing U.S.-China tensions over rare earth exports, tariffs, and technology transfer restrictions. From an investor perspective, the Blackwell chip embodies both opportunity and risk. On one hand, domestic production reduces supply chain uncertainty and aligns with government initiatives to incentivize reshoring of critical technologies. On the other hand, scaling production in the U.S. entails higher costs relative to offshore alternatives, given labor, energy, and capital expenditures. Analysts and institutional investors are carefully weighing whether the premium paid for domestic production will yield long-term strategic advantage or compress margins in the short term. Next, the slide addresses Q3 earnings season, which formally begins with technology companies reporting results that are expected to show plus 22% profit growth on average. While such growth is impressive, it is important to note that earnings estimates often lag reality in rapidly evolving sectors such as AI and semiconductors. Companies are aggressively investing in R&D, hiring specialized engineers, and ramping up production capacity to meet anticipated demand. These investments, while critical for long-term market dominance, can temporarily compress margins and create uncertainty around the sustainability of reported profits. Investors therefore face a balancing act, celebrating headline growth numbers while scrutinizing guidance and capital expenditure plans for hidden risks. Another key element is AI capital expenditure, CapEx. Global spending on AI infrastructure and development is projected to hit $375 billion in 2025, a massive plus 67% increase from the prior year. This includes investments in computing hardware, cloud infrastructure, AI software development, and workforce training. While this represents an unprecedented growth trajectory for the sector, it also raises important questions regarding ROI and timing. High CapEx can weigh on free cash flow in the short term, creating potential conflicts between reported earnings and actual liquidity. Market participants are closely monitoring whether AI investments translate into measurable revenue gains and profitability within the next 12 to 24 months, or whether they remain speculative, hype-driven expenditures that could disappoint expectations. Trade policy, particularly U.S.-China tariffs, forms the third pillar of this slide, even as Trump's unsustainable 100% tariff threat has been temporarily downplayed. Lingering trade tensions still cast a shadow over corporate planning. Tariffs on raw materials, electronics components, and AI-related hardware can materially impact production costs, pricing strategies, and global supply chain decisions. The interaction between tariffs and AI CapEx is particularly notable. Companies may accelerate domestic investment to avoid future exposure to tariffs, but doing so increases near-term capital requirements and operational complexity. For investors, this combination of policy uncertainty and heavy investment creates a nuanced risk landscape that requires careful analysis.